Start video. Good afternoon, everyone. Welcome to TSP Tips Investment Strategy. And could somebody go on chat to make sure I'm coming through loud and clear, please? Let us know. Okay, good. Thank you very much. By now, everybody's had a chance to go ahead and take a look at this intro slide here. This is the kind of theme that we're going to carry through much of the presentation and has been the cornerstone to the investment strategies that we've developed and followed over the years. Basically, it's a supply and demand driven type of strategy. And the biggest thing with all technical analysis is that you don't let emotions drive investment decisions. So with that, I'd like to go to the first intro slide, which there you have myself. I'm Roy Weisert. I'm president of Weisert Investment Services. I team with Justin with Investory LLC. He does the admin side and I provide the investment services. You can also see that besides TSP Tips, we have a service with another fund company called ProFunds that we call ProFunds Tips. And overriding both of those, we do manage money for individual clients. Overall today, the presentation will take about 15, 20 minutes, plus or minus, and then we'll go into a question and answer. And here are the 6 major areas that we'll be talking about in the next 20 minutes. Okay, what do we have here? As a little bit of history, you can see this is a time frame between 1994 and 2013. And this incorporated both of the major bear markets that occurred in 2000 and 2008. Basically, the dot-com era was the first one, and the second one was the financial mortgage problems that we had. And you'll notice, though, that that number of the S&P 500 is 1472. So basically, it ramped up, got up to a high of 1472, had a bear market, a bullish phase, lost everything. And if you'll see that, basically in 13 years, you finished up where you were, and which led to what I call the buy and hold calamity, driven by avoid large losses. And so we use that with the technical analysis in order to build a lot of our strategies. And these strategies have been around for quite a few years, and we've modified them due to different market conditions. Now, how can we go ahead and minimize those large losses? First thing is moving averages, and this is from a macro perspective of just using 2 moving averages over that same period. You have a 50-day moving average and a 200-day moving averages, and they're depicted in the red or the pink and the black lines. And when where the first red circle is, where it crosses on down through there, that's called a death cross. And at that point, you would move into cash. And then conversely, with the green circle, that would be a golden cross where the 50-day moving average crosses above. Now, that'll occur with all different time periods, but for a macro perspective, the 50 and the 200 days seem to work well. Now, how would it look like if I got out at that very first red circle and moved into cash? And what you'll see here next is basically, it's a stair step your way up. And with investing, it takes time, patience, and persistence. So instead of having $10,000 and having that same $10,000 13 years from now, you can see how we stair stepped it up by avoiding the 2000 bear market. It increased up to about $3,400, $13,406. And then if we avoided the second market, it went up to $17,609, much better than the $10,000. Now, there are instances besides those those large losses which occur. So let me show you a table of all the different transactions that occurred using just this one bear death cross and golden cross strategy since 1970. And here you have it. You can see Actually, it's pretty unusual. Looking back at 1970, the S&P was only 83. But you can see here, the summary box on the left side, you're showing 26 instances that this cycle occurred. Yeah, and the average trade was about 16.5%, 16.7. Greatest was in 1994, well over 100. And the most important part is that the greatest drawdown or the greatest loss was 10.82%. So that encompasses all of the different crosses over the last 50 plus years. Okay, next slide, please. Now let's take a look and see how that crossover strategy looks currently, okay? If you go look at the chart, these are the charts that that are available in Yahoo Finance, so anybody can use them. When I did the crossover strategy, I just want to talk about the chart itself first. You'll notice this is not a line chart. This is a candle chart. And in case if somebody is not familiar with it, each candle or each bar represents the market's movement over each period that is selected. In this chart, you can see it's 1 day. But if you notice that in the body, in the bars themselves, these bars always show the high of the day, they show the low of the day, but the only difference is that a green bar is signified as an up day, where it opens up at the bottom of the bar and closes up at the top. Conversely, a bearish day or down day is when the market opens higher and then closes lower than the open. And that's depicted by the red. And now you can see here, this is using the 50 and the 200-day moving average. And we use this a lot to pick where you are in the overall cycle. And you'll notice that on March 15th, this is when the market had that death cross. He gave us a little bit of a head fake there in the month afterward, and then it started its downward trend. And this chart is depicted through last week. All right. The other thing on this chart that I'd like to point out to you, I've kind of looked at the timeline down there and said, these are the last half a dozen allocations that we've had with TSP tips. And so they occurred, let's say we started to see the ramp up reversal to the upside on the 22nd of January, started to move, 22nd of February, started to move some money out of the G fund, and then it reversed itself around to where we are now. As of the end of April, we sent out a reallocation in order to go to 100% into the G fund. And that's where we currently reside. Okay, so next slide, we're going to go ahead and take a look at, besides the moving averages, this is what I call a 2-bar reversal strategy. Now, this is important because it signals a change in direction. And we usually use this as the initial signal for getting in on the bull side and getting out on the bear side. So you can see the previous chart had a periodicity of 1 day. The TSP is a little bit different. You aren't allowed to do any daily reallocations, and you're restricted by 2 exchanges per month. So what we've found with TSP is to use a weekly bar. And there it consists of the action of the market over the whole previous week. Okay, so let's take a look at when we get out of the market. And let's look at that very first sell sign at the beginning of 2022. You have to remember the first day of trading day of 2022, the S&P 500 hit a new high. And that was depicted right there where the pointer is right now, the 3rd of January. So that started the initial downward week. Now, what we do is that you'll notice I always look at, for the reversal on the sell side, the last 2 green or up weeks that we had. And if you'll notice that after the first week in January, I looked at the last 2 green bars. They don't have to be consecutive. You just look at them and you pick out the low point of that. And you drew a line there, and that is the point where we take an initial reduce your equity allocation. Let's say in this case, it was the C fund. And we always look at the S&P 500 because it is a proxy for the C fund. There are other proxies that we'll talk about later, but that's why it's so concentrated on the S&P 500 here. So you can see the reversal there to the downside, and that's we would lighten up on the equity positions that we hold. Then at the second week of March, it started to come around, and we had now we're looking for a buy reversal, 2-bar buy reversal. And on the buy side, it's just the opposite. I look at the last 2 red bars, the last 2 red down bars. I look at the high point, and then I draw a line, a horizontal green line that would establish where we would start to get back into the market. Okay, we did get back into the market. We looked like it was going to break out even further, but then again, it turned around in beginning of April, the end of March. We started this current March that we're on to the downside, and with now 7 consecutive weeks of bearish moves. You'll notice that we sold out of the market some on the second week of April, and currently for the last 2 weeks, we would have a reversal if the S&P 500 broke through the 4090 level. And we don't wait really in most cases for the week to complete. If we see a midweek where the price either crosses above or below, giving a buy or sell signal, that's when we'll send out the midweek alerts. Okay, next one. This is the 2-bar reversal strategy back in the last bear market that we had, pandemic, in 2020. Again, we're looking at 1 week periodicity. The left circle says this is the beginning or the end of January 2020 up until the end of April. And you'll notice the 2-bar reversal. So we would have gotten out probably about mid-February when the S&P 500 crossed 3214. Conversely, down towards the bottom, towards the end of March, we would have drawn a green buy sign at the high point of the last 2 red bars, and we would have gotten back in around 2641. The nice thing here is that you would have saved about 600 points on the downside. It's very technical analysis in order to take the emotions out, but you would have saved, like I said, about 600 points or so to the downside, somewhere in the 15 to 20% range. Okay, on the next slide, let's go into the next strategy that we use a lot. And you'll hear me talk about breakouts. Now, this is building on the 2-bar reversal. If you look at the first sell that we had in 2022, which was around the middle of January, we sold out at that dash line. That's that same line that was 2 slides earlier on the 2-bar reversal. But instead of drawing the line as a dash line, it now becomes a high point. You see it when we had the 2-bar reversal, we saw that 1 month a week at the beginning of January. We picked out the high point, irregardless of the color, and we put a resistance line. Okay, it was never broken, so we just disregarded it. This breakout trade is usually the last trade that we'll get through a cycle, and what it does is that it confirms a new trend as you look through it. So then looking at the support side, which is at the last part of February, the beginning of March, you'll notice we did a buy, and so we put a support line running from the lowest point of that reversal. It came across, and what happened there? It broke through there, that red bar line with the thunderbolt on it. It broke through it, showing that it was confirming a new trend, And that's when we went to 100% in cash where we currently are. So again, you can take a look at all these slides. These are being recorded. I mean, this presentation is being recorded. We're going to post it and provide directions on where to find it on YouTube. But so you can review this at any other time that you'd like. The last one that I'd like to talk about and use here a lot of times is the performance ranking. Now, the other strategies that we looked at, the golden cross, death cross, the 2-bar reversals, the support lines, support resistance lines, that pretty much tells us when we want to go ahead and get into a fund or out of a fund. But then within the 4 individual funds that we have within the TSP, how do we know which ones are best performing? So this is how we do it. We take a look at each of the CS, or in this case at the bottom there, FICS. We look at each of those funds. We have a program that does this, a software package, and it takes a look at the 1-month return, the 3-month, 6, and 12-month returns. And then it gives it a weighted average, putting 40% weight on the shortest period. 3 months is 30, 20, and 10. And we basically combine them, sum it up, and then sort it best to worst. As you can see at the bottom down there in the table, the green shaded area shows you the monthly returns for each of those 4 periods, for each of those 4 funds, multiplies it out by the 0.4, 0.3, 0.2, and 1, and then gives you, in this case, the F fund, a minus 4.88. This just illustrates how weak the market has been this year, because usually, let's say in 2021, it was much better. And these funds during a bull market, they will all be in the positive and have similar type returns, but with a plus sign in front of them. So how can you find out what the performance ranking and rates of return are on these on the next slide, which kind of shows you, this is a good proxy slide. I ran this, and this is based upon last Friday's close. I pulled this up over the weekend, and it's similar to some of the other charts, again, available on Yahoo Finance, but I originally called up the S&P 500, which is listed in that red proxy box to the left. And it gives you the candlestick chart of the S&P 500 for 1 year. Again, I used a 1-day interval on this one because you're just looking for the performance ranking. Now, this was a screenshot for the 1 year. And if you scroll around, if you look at the proxies, what I did is I typed in the corresponding proxies for the S, I, and F funds. So you can see the S fund, it's DWCPF. Now, if you look at the chart, the lines to the right, let's take a look at the S fund. You can see for over 1 year, if you have the the S Sierra fund, you'll see that its return has been minus 22.65. Conversely, over a 1 year period, the S&P, which is the candles, has a 6.12. Then you can see the F fund is down minus 9.72 over the last year, while the I fund has a negative return of 15.32. And again, that tells us where to go ahead and get the numbers for the performance ranking. You can also, while that's one gives you the 1 year period, you can use a spreadsheet, use the formula, and then select individually the other 3 periods, that being the 1, 3, and 6 months. Okay. So that tells you where to. Now, the other thing I'd like to mention as follow on, besides doing the TSP tips, Wiser Investment Services manages monies for other clients. And we also have another tips model, which is ProFunds tips. This is a little bit different than TSP in the fact that it does use daily monitoring, and you're not restricted to 2 exchanges basically for the month. All the gains are for tax deferred accounts are all the gains are going to be short term. So we do recommend that you use these in tax deferred accounts. And this was just the allocation, similar to what we send out with the TSP for the different models. The two models, one in the middle and the first other one on the right, they use leverage funds. So instead of the TSP funds, which have a 1-to-1 ratio, these funds have the ultra funds, let's say, and the sector have either a 1.5-to-1 or a 2-to-1 ratio. And you can check it out on the website. Just go to ProFunds.com and you'll see all the different funds they have. It's a nice family of funds. Okay, now let's take a look at the avoid large losses with what happened with the ProFunds tips. The same thing, looking back at the pandemic time, when that came in and created the bear market, historic drop, historic return. But again, it's avoiding those large losses and then stair-stepping yourself up. Okay, next one, please. And this pretty much wraps it up. This is what I picked out the other day, how long do bear markets last? And the interesting part about it, it kind of outlines on the right all the different bear markets that we've had over the years. And you can see there on the left side, 289 days, average decline 37%. And where would that be if history could repeat itself? It was saying that the bear market would end on the 19th of October of this year with the S&P at about 3,000. Again, right now, the S&P is just at the fringe of going 20% down, or the technical definition of a bear market. And then the last one that we have is to kind of say, at times we get led into a sense of complacency, let's put it this way. Since the financial crisis in 2008, we've had pretty much a strong run on the market, which is the right side, what those 13 years. Conversely, if you look at those first slides that we were looking at from 1999 and through 2013, are we going to have a repeat of that kind of market? And while no one can predict the future, that's why we always use the charts, the numbers, and the technical analysis in order to take the emotions out and try to determine when we would get us in the market. So with that, I'm going to leave up some of these notable quotes, and I'll take one question verbally. First of all, we're going to switch over to the camera right now. If you give us a second, type your questions into the chat. And just give us a second to regroup here. And you should be able to start to see my face coming up on the screen. Okay. Okay, let me look. We have one question here. Yes, we are going to go ahead and we can send out the email also. That's a good thought to all the people that signed up and registered for this presentation. Additionally, as I mentioned, we'll have it posted, a link to it on YouTube. Okay, let me scroll down. Anybody else have another question? Was that it? Okay. This is a good time to ask a question. I'm not getting much chat.
Right here.
Let me see here.
At what age should you pull out
Okay, I see it. My beautiful daughter is helping me accomplish this. Okay, we're getting it right now. At what age, Juan wanted to know at what age we should roll out of TSP. Personally, I still have my TSP, but I prefer to be able to self-direct my money a little bit more. So when the opportunity for me, I was able to pull it out with an in-service withdrawal, I took the money out, the majority of it, and moved it into the ProFunds tips, just because it gives me more flexibility. But the TSP is a good system. It's going to be, as everybody knows, there's going to be some changes to it. I think the allocation that we have is good, but that requires a little bit of, when you should roll out, it's hard to give a blanket answer. Personal preference to me was I like to be able to dictate my investment decisions a little bit better. And I would prefer to move it into even a family like Fidelity or something like that, where you have more control. Okay, Chris J, to everyone, as a retiree, should I follow Justin and Roy's recommendations? Yes, you can. And it's a matter of risk. Again, it depends upon how much money you have. Just because we provide these recommendations, you don't have to apply it to 100% of your TSP account. If you feel you're comfortable with a return, if you're able to supply the majority of your income stream that you need for retirement, yes, go ahead and try to move it into the G fund or whatever. But you do have to do a little bit of analysis and say, how much do I need each month? And what is my risk profile? How much am I willing to do? Again, that's why we kind of use those strategies that we have there. And personally, we try to manage the strategies to each of the different clients that we have. So real hard to give you a blanket answer, but we manage the risk as you near retirement by just keeping on following the same strategies that we've briefed here. Okay, how do you determine the allocation percentages? Okay, remember that performance ranking that we showed you with the 4, 3, 2, 1 rate of returns for the 1, 3, 6, and 12-month periods? And we sorted them best to worst. So I'll take a look at that. And as it comes around every week as we do the analysis and come down, we follow the funds every day. But on a weekly basis, if we see we're going to have a change in strategy, what I'll usually do is try to keep us in the top 2 funds. And let's just say one fund, the top fund, had a performance ranking of 10. The second one had a performance ranking of 5. I sum them up, has a total of 15. And at that point, I'd use 10/15 or 2/3 of it would go in the top performing performance ranking fund and 1/3 into the other one. Now that's if, let's say the other one, it also needs to make sure that it meets the buy criteria that we discussed with the reversal and the support and resistance. So that comes into play. It's been a tough year in 2022 because all the funds have been down. And that's why we kind of stuck with the C fund, because it was the best of the worst, let's say. But that's how we make the recommendations in order to overweight that. It's highly unusual if the performance ranking is close between the CS and I funds and nothing stands out, is break 1/3, again, using prorated amount on the performance rankings. Okay, Ken said, thanks. Appreciate the proxy for the F1. Didn't have that one. Yes, you're welcome. That's good.
No, that's the F1 proxy.
Okay.
You didn't have that on the chart.
Okay, let me go back on the slides. What the proxy is for the F fund. I'm pretty sure it was BKAG. I'm just looking it up for you, switching here real quick. Sorry, we'll get there. But I'm pretty sure it was BKAG. Okay. Yes, it was. Okay, we'll go back to the video there, BKAG. Okay, now back to the chat. Okay. Okay, at what point do we need to put in the C fund? I had that one chart that showed the reversal points and I had the lightning bolt. And so again, I would use what we're looking at in order to get back, start to get back into the C fund. If that still has the best performance ranking, would be, again, looking at the last two red bars, pick out the high point of those last two red bars. They don't have to be consecutive, but just check them. Draw a horizontal line across that. And on that one slide where I had the lightning bolt, I'm pretty sure it was 40.90 was the high point of the last two red bars. So that's when we start to take a look and get back into the C fund. Right now, we're about 140 points based upon a 39.39 closure on the S&P today, 39.40. So about 150 points away, 4% or so. Actually, here's one that says, should L funds be an option once you retire? The L fund is set up, it's an age-based retirement fund, meaning that if you can use, basically in a simplistic method, it says whatever age you are, that's how much you should have in the bond fund. So if you're 30%, I mean, if you're 30 years old, should have 30% in the bond fund and 70% in the equity funds, the CS&I. Conversely, a 68-year-old, a 68-year-old would have 68% in the bond fund, the F fund, and the other 32% in the equity funds, which are the CS&I. Now, I can tell you, we have on our other presentations that we give, I was just looking at the strategies, but just because you have that strategy and a lot of people are learning it today or this year, is that the equity funds seem to march in lockstep with us. And what's highly unusual right now is that, say a person was getting ready to retire and they had it in the L fund. Just because you have it in the L fund, you might have 60 or 70% in that bond fund, which is the F one. And as interest rates increase, the bond fund goes down. And the bond fund has had a negative return. And looking at history, the last 2008, the bond funds also took a hit there. So again, it's not going to protect you completely in L fund. It'll protect you somewhat. But again, we prefer, and the way I manage my individual clients' accounts are to move it into a cash using that performance ranking as the determination of how much to be into it or where to invest in these strategies in order to manage the risk. Okay. Okay. Next one is, what is the lowest fund can go down? Whoop, we're getting there. What is the lowest C fund can go down 40%? Well, it can go down. Yeah, it can go down 40%. If you look at the C funds, let's go back to 2020 when the pandemic hit. If you looked at its highest point before it started its march downward to the exact lowest point, I think it came close to hitting 40% down. I'd have to go back to the numbers on the TSP site and see what the high and the low were for those years. Or you could just go to Yahoo Finance and select the S&P 500 and find for yourself. But that has, it can go down. What was it? Snap today, one of the stocks I know in the market that had bad projections. Its earnings report came out, and that's how much Snap went down today in one day. Conversely, Target went down 25% in one day last week. Okay, I'm going to move on down the chat to Philip Lutz, and says TSP has low management fees. What are the fees for the programs you just mentioned? to us. The TSP, the ProFunds tips, they're a little bit more expensive. I'll have to look at what it is again, and they're probably, I'd say, depending upon how many models you want on an annual basis, somewhere between $79 a year and $150. Okay, but again, that provides the daily monitor, and we do recommend if you're going to use leverage funds, it's a little bit difficult. You have to be involved with that. For my individual clients, when I do everything for them, I look at their account value at December 31st, and we agree upon a charge of 1% of whatever their account value is on an annual basis, and that's how we do it. As a retiree, can I move my pre-tax TSP dollars into a Roth IRA without penalty? My pre-tax TSP dollars into a Roth. Let me just qualify that. And I'm thinking that you have a Roth TSP and you want to move it into a Roth IRA, let's say with ProFunds or Fidelity. Yes, you can do that. You can do that at any time, whether you're retired or not. So it's the major problem you have is that with any of these tax deferred or tax free retirement accounts, the biggest restriction you have is accessing that money before 59 and a half. Of course, with Roth, you don't have to worry about paying any taxes when you move it. I mean, when you eventually take it out of your IRA. If it's in a taxable TSP, yes, you can move it into, it would probably be better to move it into a taxable IRA. And then once you make it into the taxable IRA and it's set up in the fund company where you're eventually going to keep it, then move it into that family's Roth IRA and pay the taxes on it. The reason is that when you try to do a conversion from a taxable TSP directly to a Fidelity Roth IRA, the paperwork will inevitably get confused, and it's much more to move all the funds out of the TSP that you have over to a a traditional Roth IRA, traditional IRA, and then execute the conversion to the Roth IRA at that point. If interest rates go to 4 or 5%, will a G fund be a safe option if your balance is 7 figures? The G fund is always going to increase. It's pretty much guaranteed, but it's going to be difficult for the G fund to get to 4 or 5% when they're talking about interest rates or inflation right now at about 8%. So let's just say G fund is generating 2% a year with inflation at 8. I'm thinking that in order to get a 4% rate of return on the G fund, we're going to have 16% of inflation. It is true though, that the G fund is a stable fund. The return is going to be less, but I think a lot of people have some misconceptions with the bond fund on how bond funds move just in the inverse of what interest rates do. So while interest rates are increasing, which they are currently with the Fed, that's why you're seeing all the bond funds losing their values. Okay. What was the name of the other tips you mentioned as more flexibility? It's a company called ProFunds, PROFUNDS. And that's the company. It's like the TSP. So it's just ProFunds, and then tips is a strategy. In order to define, we use similar strategies across different fund families. And again, you can find that on the web. And there's also a website for ProFunds tips. You can Google that one. Did you develop this method yourself? Well, those on the intro slide that came up with the price as the resolution, of all forces. I've read a lot of books and things like that. And I've been doing this for a while, since about 1972. I've seen what works and what doesn't work. So a golden cross and a death cross, that's well known. They have some reversals with the 2-bar. Some of them might use 3-bar in order to be a little bit more convincing. But then again, I found that the 2-bar reversal gives me a high percentage in order to get back into the market and or get out. Okay, but yes, I've done a lot of research on these, and I love investing and have a good time doing it. Okay, somebody I have 6 years before retirement. Is a 60-40 a good mix with lesser in stocks? I'm 59. As I mentioned, that's the problem you run into with these life cycle funds. If you had a 60-40 mix right now, let's say it was 60%, which is your age, you say you're 59, and 40% in stocks, and I'm going to assume it's the S&P 500, let's say, just to make it easy. Yeah, you're going to have, your return isn't going to be looking at good, this year. It's hard to swim, let's say, upstream or go, go sailing directly into the wind, because all the funds seem to have hit records at the very beginning of the year, and they've been just selling off throughout 2022. Hopefully, I'm hopeful that this will change stream and we won't have to be putting up with much bear market. But again, increasing your percentage in the F fund, let's say, yes, that's good, but it's not going to be perfect in the world. Okay, but you will assume less risk. Okay, next one is, what is ProFund? I think it is. What is ProFund better than TSP funds? ProFunds, again, it's for, it's not, we use ProFunds because we feel the funds are very good. They're all index funds. You have a much more diverse family of funds than just 4, let's say, like the TSP funds. And yes, we've used them throughout those years. You notice with the ProFunds, I showed you how did ProFunds do in 2020. Again, same strategy. We avoided large losses and stair-stepped ourselves up. Again, you can find out more at their website. They've been around since about 97 or so, maybe a little bit later than that. And that's about it. Okay. Okay, let's see what more we have. Okay, we still have some time. Okay, just somebody saying thanks. Where do we go to sign up for ProFund tips? Is that a separate app? Yes, it is. And you can get there by just type it in profunds.tips.com, profunds.tips. Okay, next one we have is, okay, let's, yeah, from what we're kind of discussing here right now. Okay, I see somebody provided the information. Okay. Okay. Can we get a copy of the slides presented and this recorded meeting? Yes, we'll send out the record and the presentation. How do you compare Fidelity to Vanguard? I prefer Fidelity. Vanguard's puts too many restrictions on how you can move the money around. And then, is derivatives trading part of your strategy? No, not really. But within ProFunds, in order to get that 2-to-1 ratio, that is part of the ProFunds, how they can generate 2-to-1 and inverse strategies. For the amount of questions I'm seeing here with ProFunds tips, we might present a follow-on presentation in order to give it more in depth. Okay, let's see if there's anything else. We really appreciate all these questions. Thank you. Nice to see you on the screen. Thank you. And, okay. So what I'd like to do now, we don't have anybody else through the chat. We hope you enjoyed it. We really do enjoy the investments. I've brought my daughter into the fold, let's say. She's an investment advisor also. And it's fun. We've taught courses with the Bureau of Indian Affairs. And the other thing is that if you do have a question afterward, you can go ahead and either send it into contact@tsp.com. That's Justin's address. But if you need to want to address something to me directly and keep Justin out of it, a lot of times he just forwards it to me. He really does the administrative stuff. Wizard, we do have a site called wizardinvestments.com, my last name, and my email address is first name Roy@wizardinvestments.com, and it'll talk. If you can go through there and go ahead and check out a few of these things. Can you talk about the times of the year the stock market has positive runs, like the 2 weeks around July 4th and the Santa Claus rally into the beginning of the year? Yeah, there's a lot of different times of the year that these scenarios seem to play out. Another one is the first 5 trading days in January. That's how the market is going to end up. Again, it kind of looks at probabilities and kind of says, it's called seasonal trades, let's say. You can Google seasonal scenarios, investments. Investopedia is a good site, and it'll give you a plethora of all those different items that they have there. Okay, we had something else. Okay, I'll be honest, I missed the 100% G fund, and there's no point going. Okay. Okay. I'm still 80-20 the C fund, but there's no point in going 100% G fund at this time. Well, if you missed it, we always try to put out that history out there. But if you did miss it, I'm a big proponent of no one can predict the future. And you're just going to have to kind of take, if I don't know how old you are or how long, how close you are to retirement. But again, how you can manage risk at times is that instead of using our recommendations for 100% of your fund or your TSP, remember you can only use it for a small any portion less than that. Myself, if I was caught in that situation and I was aware that there was from a historical perspective, the S&P could lose 35, 40%, yeah, I'd probably decrease the amount that's in my C fund. And just a reminder, if you want to do that, you need to do it tomorrow, because I'm pretty sure the following day, the C fund or TSP is not accepting any transactions. And that's about it that we have. Again, thank you so much for signing up. We had a good crowd. And again, my email address is roy@wizardinvestments.com. And please feel free to send us an email there if you have any other follow-on questions. Okay, thanks so much. Good night. See you, Wayne.